there, welcome back to ET. Now you're watching Markets at Noon with me, Kanishka Sarkar and Ankita Saxena. Well, markets have been absolutely flat today despite a very positive month of October that we saw. And to discuss what's the outlook going forward, where could the markets head from here, we are now joined by Rakesh Vyas, CIO and Portfolio Manager at Quest Investment Managers. Hi, Mr. Vyas. Thank you so much for joining us. Firstly, what is your take on the markets right now? Absolutely flat moves today, despite relatively positive, global cues that we were seeing. But do you think this consolidation could continue for some more time, or are we in for a rally going forward in November?
Yeah, hi, good afternoon. No, you are right. I mean, market has been consolidating for last 12 to 15 months effectively. It's also on the back of slightly tepid earnings growth that we have seen from the broader market in general. But as you move into second half of this fiscal and FY27, we believe that the earning growth trajectory will start to improve materially, and therefore market should start to reflect the same. We are expecting 12 to 13% earning growth over next 4 to 5 quarters, and therefore the market should also start to generate similar kind of returns. So I think market, after consolidating a bit, probably is looking to break that trend and move higher from here on. A large part of it is also driven by a lot of policy actions that were by government as well as RBI to boost the consumption and the liquidity into the system. So a lot of it is going to help. And on top of it, if US India tariff deal do go through, then there are many other sectors which will probably see a strong traction going forward.
Right, Mr. Vyas, this is Ankita also joining in. Good afternoon to you. So what are going to be the next positive triggers for the market? One would be the earning pickup that we see in the second half of this fiscal, but also we have the overhang of FII selling, FIIs continue to sell, and the selling just does not stop. When do you see that happening, and when do you see FIIs really make a comeback?
So if you look at the FIs historically, they have always chased growth. Unfortunately for India, over last 6 quarters or so, the earning growth trajectory has been missing. And on top of it, valuations were reasonably fair. In that context, FIs did find a lot of opportunities outside of India to invest, where either the valuations were reasonably cheap or there was a reasonable strong earning growth trajectory like US, etc. However, as we move into next 4 to 6 quarters, I believe that the earning growth will come back into the corporates, and therefore over time, over next 4 quarters or so, my belief is that we'll probably first see subsiding of this FI outflow because earning growth will support the valuations that market is today in, and then therefore if the trajectory continues from there off, then we probably could as well see FI inflow. But I think it will be a gradual process, but I'm fairly hopeful that over next 4 quarters, we will see change of trend.
Okay, so there could be a change of trend over the next 4 quarters. That's the word coming in. But Mr. Vyas, you were highlighting earlier how there are a lot of consumption-related triggers that are positive for the market, whether it is RBI boost or GST-related boost. But what's your view on the CapEx front? Where do you think private CapEx recovery is likely on the cards? We have mixed commentary coming from managements. One of the largest infra players did say that they are seeing a slight pickup, but that commentary remains diverse for the past few quarters. When do you see a pickup in private capex?
Yeah, so if you look over last 4 5 years, large part of the capex growth actually was driven by government. From 2009 to 2024, we saw very strong growth spending by government, which drove the public sector capex. Over that time frame, because of the minimal growth in the consumption sectors in general, we saw corporates actually focusing more on deleveraging their balance sheet or strengthening their balance sheet because utilization levels were still relatively low. But with all the boost that is coming in now, effectively from the consumption side and also probably from the retail lending, etc., the utilization levels are expected to move up gradually from here on, and it's probably an opportune time for the private sector capex to kick back in. And also the focus for the government is on Make in India, and therefore a lot of incentive schemes are coming through. There are sector specific tailwinds that can come through from supply chain relocation from China, etc. So there are meaningful potential upside that can come through from the private capex side. But it would still be a gradual process. We remain fairly hopeful that over next 12 to 18 months, we'll see reasonable growth coming from private capex.
Right, Mr. Vyas, since this next leg of growth is going to be led by consumption and not as much capex-led growth, as you mentioned, what are the pockets where you find value? Are you incrementally now positive on the consumption basket? Especially the FMCG basket that has been languishing for a while. And what are the pockets of value? What are the sectors that you are incrementally bullish on now?
Yeah, Ankita, if you look at our portfolio positioning for last almost 6 quarters or so, it's fairly been more positively tilted towards the consumer discretionary space per se. And it's also helped by the pivoting of the government from, as I said, capex to consumption, because a lot of the consumption-driven policy changes that has come through over last 8 to 10 months is also going to have a strong tailwind for that space in general. Uh, Effectively, if you see consumer staples per se, I think that is a space where the earnings growth trajectory is still going to be relatively more muted, despite the fact that customer now have large disposable income in their hand, which we believe will probably go more into the small ticket discretionary spending or even on the premiumization or travel hospitality space, not so much on the consumer staples. And in consumer staples, despite the fact that the earning growth trajectory is going to be slightly more muted, the valuations are still reasonably expensive, and therefore we have remained outside of that space for a reasonable period of time. Our continued focus remains on sectors where the tailwind of all that disposable income coming into consumption will flow through, which is either into retail, hospitality, and to some extent real estate as well.
All right. Thank you, Mr. Vyas, for sharing that outlook with us. On that note, we'll let you go. Thank you so much for your time.